Welcome to Close of Business. I'm Alicia Barry. The US president has boasted America's economy is the hottest in the world right now. Donald Trump promised prices would fall on day one of his presidency, but the latest data shows inflation rising and job numbers falling. Leading international economist Justin Wolfers warns Trumponomics comes with the real risk of recession. Justin Wolfers, welcome to Close of Business.
A pleasure, mate.
Trump has claimed America has the hottest economy right now. Is that the case?
No. We've seen the most important economic indicator we have is employment growth. Employment growth has slowed very sharply over recent months. Probably you can date that to April. April 2nd was the day he promised to liberate the American economy. It seems that he's liberated us from jobs growth.
Can you provide some context about the state of the US economy?
Right. So Trump came to power. First of all, Doge started to cut a bunch of federal jobs. We've got chaos in just about every sector of the economy due to all sorts of actions from the president, not just tariffs. As a result, economic uncertainty is at an all-time high, or not right now. It's actually come down a little bit, but it's still at extraordinarily high levels. We've seen over the past few months, job growth has slowed quite dramatically. GDP is not currently a useful indicator because every time people worry there's going to be tariffs, there's a big import surge, and then that hollows out what would have happened the subsequent quarter. If you ask people if they expect unemployment to rise or inflation to rise, they say yes, and that's the only thing they're enthusiastic about. And businesses feel absolutely down about the economy. We still have a policy mess. It's not just tariffs, it's also uncertainty and, quite frankly, competence. You have the president trying to take over the Federal Reserve. You have the president firing the head of one of the major statistical agencies and trying to replace them with a partisan fool. None of this engenders confidence in the US economy.
Where does the US economy go from here?
Well, I'll tell you what I hope and I'll tell you what I fear. If I forecast the economy, that has to be some forecast about what I think the president will do. So let me back off from doing that and say instead, if the president were to act in a relatively sensible way, I think there's roughly a 1 in 4 chance of a recession over the next year. And if the president were to continue to lean into full throttle Trumpism, trying to take away the independence of the Fed, getting our trading partners offside, destroying the bureaucracy, and instituting a form of crony capitalism, I think the chances of a recession over the next 12 months skyrocket. Maybe as high as 70%. And it wouldn't just be a recession, it could well be a recession accompanied by inflation as well, which is everyone's favourite, stagflation.
So is stagflation a realistic possibility?
Oh, we're already in the early days of it. Stagflation's two things. Stagnation. Well, already we're seeing the unemployment rate very, very slowly creeping up. The other part, inflation, already we're seeing inflation slowly creeping up. We haven't seen much of the effect of tariffs yet. What's happened with tariffs is that other countries aren't cutting their prices as President Trump promised us they would. Instead, they're keeping their prices high, which means American importers, the stores, are paying those tariffs. They haven't passed those on yet. They almost certainly will, and they will as soon as it becomes clear that these tariffs are permanent. But still, American tariff policy is on again, off again, and it may well turn either on or off again awfully soon.
Jay Powell has recently said that a weakening jobs market could temper tariff inflation risks. The market is expecting 4 more rate cuts in the next 12 months. What's your view on where rates could go?
All of this makes it very complicated for Jay Powell. When you raise inflation, you normally raise rates to counter it. When the economy slows, you normally cut rates to counter it. The textbook, in fact, says if it's a supply shock, it should be transitory. So maybe you should just look through it and hope it'll all go away. We just had an episode a couple of years ago where people talked about that word transitory a lot. And it would take a very brave economist right now to say, oh, it's just going to be transitory and look through it. So the Fed is in a very, very difficult situation right now.
Trump has repeatedly attacked the Fed chairman. He's trying to remove Governor Lisa Cook over claims of mortgage fraud she denies. Is this just about rates, or is it about gaining control of the US Fed?
It's definitely way more than just a cut in rates at the next meeting. The governor that the president has tried to fire, Lisa Cook, is not only a friend of mine, but also a neighbour. He's gone after her with, as far as I can tell, absolutely no legal grounding. He's been quite explicit that his plan is to stack the Fed with Trump folks. The problem with not having an independent one is monetary policy would be run out of the White House. The question there is, would you rather monetary policy be run in the best interests of the American people or President Trump's political interests? And in fact, it's a step worse than that. President Trump has very strong views about interest rates. He's a former property developer. Property developers love low interest rates. We've actually seen this play before. What happens when a populist strongman with a love of low interest rates comes to power and takes over the central bank? This is what Erdogan did in Turkey. So we've seen literally this movie before. And in Turkey, inflation went from pretty normal rates up to 86%. And last I looked, it's still in the 30s. Look, there's a lot of economic debates that come down to, can we be a percentage point better off here or a percentage point worse off there? But the most important thing in economics is to avoid a crisis. This sort of thing could create a crisis. This is where economics really matters.
Justin Wolfers, thank you so much.
Great pleasure.
The Trade Department is being accused of running an unfair and opaque grant process for exporters. Data from Austrade reveals businesses are waiting longer than usual to find out if they're successful, and more of them are being knocked back. It comes on top of the difficulties of navigating US tariffs. Amelia Terzon has been investigating.
Gal Benjamin's sustainable packaging business is exporting to countries around the world. It uses an Austrade government grant to help pay for costs like overseas trade expos and flights.
It's very important to our business to have the grant. It's always been quick, straightforward.
But the business's latest application is still pending, and Gal wants answers from the Trade Department.
It's 9 months that we are waiting. I think the way that they changed the grant rules this year is very strange. I've been going to local politicians because I can't see any other way.
This was for a Tier 2 submission.
Gal's agent, Kate Whitehead, has many clients that are battling the system after Austrade changed application requirements.
They decided to implement a first-in, best-dressed model. So the applications were lodged, the window opened, and then they would close the window based on the applicant numbers, depending on their estimated budget spend.
In November, applications for one round of the Export Market Development Grant closed after less than 4 hours.
People have likened it to a Taylor Swift concert, right? So the fastest fingers won. There were several instances nationally where people complained that they had missed out because the portal had crashed.
The current first-come, first-served policy definitely has created lots of problems. And personally, I think the biggest problem is it can create competition.
Austrade says it brought in this new system to ensure that successful businesses are given bigger grants.
The policy was trying to make some adjustments to simplify the process and also to increase the potential effectiveness and impact. But these adjustments have actually created some unintended side effects.
9 months on from the latest round opening, just 70% of applicants have offers.
And what percentage have we got in there, in the bath?
4%. Another company that's still waiting for an outcome is chemicals manufacturer Healthguard.
It's put us in limbo big time. We had wanted to make a new website, or host a domain over in Hong Kong. We've had to rescind, obviously, on that.
Victoria Harvey says the first they heard from Austrade was in July, when the department sent them a rejection letter claiming that Healthguard had uploaded incorrect information.
So we have then appealed that process, which was accepted, and it's apparently under review for the grant agreement.
Several consultants, including Kate Whitehead, are lodging formal reviews with the Commonwealth Tribunal.
We've had several instances where the clients have received a notification of rejection from Austrade because Austrade can't open those attachments.
A lobby group that Kate heads up has just released a report about the export grant. The Melbourne University study found the scheme delivers bang for buck, even though it's only getting about a third of the funding it got 25 years ago when taking inflation into account.
What Labor did was actually cut real money from it, $40 million a year, so that was a real blow to the program.
Criticism of Austrade's signature grant is coming as many Australian companies are also battling the impacts of Donald Trump's tariffs on American imports. The opposition says that Australian exporters are being neglected. Both Austrade and the Trade Minister, Don Farrell, declined to be interviewed. Austrade's grant is currently being reviewed as part of a 5-year requirement.
There's a lot of flaws in the system, so that obviously has to be looked at in this review process. I think Austrade can do a lot better job.
The department says that every business that's eligible for a grant is going to be notified by mid-September.
Change the system. It's not the right way to treat small businesses.
Austrade has told Gal Benjamin that her business's offer is imminent, a day after she told Austrade that she'd been speaking to the ABC.
Interest rate cuts are welcomed by people with a mortgage, but they aren't helping those who are trying to save for a home. The rates banks are offering on savings accounts have fallen after 3 cuts from the Reserve Bank. Emily Stewart takes a look at some different savings options.
Stuart and his wife Rihanna have spent 2 years saving for their first home.
Since having our daughter, it's been more difficult to save the amount that we need to, which pushes the horizon of when we could buy a house further and further away.
And now the return on their savings has dropped.
Our interest rates this year have decreased on our savings account, broadly in line with the cash rate cuts. We started the year with a 5.5% interest rate on our savings account, and currently we have 4.8%.
With the Reserve Bank cutting the official cash rate 3 times this year, the rates banks will pay on savings has fallen. CanStar's Sally Tyndall says there's now just one lender offering an account at 5%.
But there's plenty of catches that come with this account. Firstly, you've got to meet the monthly terms and conditions. Secondly, you've got to be aged between 18 to 29 years of age.
Meeting all the conditions can be incredibly confusing. An Australian Competition and Consumer Commission report found that in the first 6 months of 2023, more than 70% of accounts on average didn't receive bonus interest in any given month.
A competitive rate at this point in time would be 4.5% and above, but you probably, in most cases, need to meet monthly terms and conditions in order to get that rate on an ongoing basis.
Term deposits are another option, says wealth advisor Sulo Kalendran. However, it locks money away for a period of time.
It does seem that the shorter term deposits offering maybe up to 90 days, that tends to be relatively similar to the longer dated term deposits at the moment. And that just speaks to what the market's outlook is when it comes to the rate cutting cycle that we're in at the moment.
Cameron hasn't put his money into a term deposit. Instead, he's put some of it into a savings account, where he's seen his interest rate fall to 4%.
For the last couple of years, I've had surplus cash, which has been quite useful because it's been in savings, so any interest that I've made has supplemented my income.
He also has a mortgage, but doesn't pay a lot of interest on it because he has offset accounts.
So I was more interested in what the interest rates were doing from a savings perspective.
Ms. Kalendran says for those with a mortgage on their home, putting any spare cash into an offset account might be best.
Effectively what it does, it reduces the home loan balance on which the interest is charged. So if your interest rate is say 5.5% and you place some money into the offset, you're effectively getting a risk-free return of that 5.5% for the amount that's sitting in the offset.
The Reserve Bank meets later this month. However, most economists expect interest rates to stay on hold, given the recent stronger than expected GDP data. Instead, forecasts are pointing to another cut in November. Cameron will be eagerly watching, with plans to upsize his 2-bedroom home.
Now with interest rates falling, I'm now looking to probably use those savings to put into a new property.
Meaning he may join the chorus of home loan borrowers cheering any cuts.
The new boss of ANZ has defended his decision to swing the axe through his workforce with 3,500 jobs to go. Nuno Matos, who took over as chief executive in May, says the cuts have nothing to do with artificial intelligence, but will make the bank simpler and leaner. David Taylor reports.
It was a dark day for workers at Australia's fourth largest bank. ANZ staff towing the company line and putting on a brave face.
Are you worried about losing your job?
No.
The bank's boss says frontline staff aren't facing the axe.
The people in the branches are not being touched. We're not touching our call centres. We are not touching, for the most part, our complaints management team.
Nuno Martos wants a leaner operation to improve risk management and insists jobs aren't being lost to AI.
This is not about profits. This is what we need to do for a brighter company, for a better company.
This is not, as the new CEO, Nuno Matos calls it, a flagging bank. Since when is a $7 billion profit flagging and failing as a bank?
3,500 jobs will go by next September, around 8% of its global workforce. Another 1,000 contractors will also be axed. Staff who worked for Suncorp Bank when it was taken over by ANZ in 2024 are protected under the bank's obligations to the federal and Queensland governments. The restructure will cost the bank $560 million before tax.
It is simply outrageous, this behaviour. If we can't rely on one of our most profitable top 10 ASX companies in this country to employ and offer good jobs, I'm not sure what we can rely on.
The Financial Services Union said staff in Melbourne are predominantly in the firing line. The union says 800 workers will find out if their jobs are going this week, while the ANZ's boss says he expects most of the job cuts will be done by early next year.
Our members are absolutely distraught. Many of them found out this morning while they were at home making the kids sandwiches for school or on their commute to work. They got their news feed on the phone.
I don't think that's true.
It's not the first time staff have been caught off guard by management. Some staff recently facing redundancy received an automated email before getting a tap on the shoulder.
I publicly came and I apologise, first to the employees and second publicly. So I regret a lot. It's an unacceptable mistake.
Analysts expect more mass layoffs in the banking sector over the next 12 months.
It has to be the tip of the iceberg because obviously ANZ is very different. But you're seeing at the moment, like obviously with the introduction of AI and other cost efficiencies, that's going to be a feature of the banking industry. So you'd expect over the next few years they'll be losing a lot of jobs in the sector.
Tens of thousands across the industry?
Well, potentially. I mean, between the major four, it could be in the tens of thousands.
ANZ relies heavily on mortgage brokers, which squeezes its margins, and analysts say the job cuts are about finding savings elsewhere.
They really need to lead into costs at the moment, and that's exactly what Nuno's doing, and it's really his only lever at this point in time.
This mass sacking of workers is another PR disaster for the bank, also facing an ASIC investigation for alleged misconduct in its bond trading division.
To the share market, and a late rally shaved off most of the week's losses. The ASX 200 and the All Ords ending the trading week mixed. Julia Lee, head of client coverage at FTSE Russell, joined me at the end of Friday's session. Julia, we saw Wall Street hit records at the end of the week, and there were other global markets up there too, not quite Australia, but is this all about rate cut hopes in the US?
Look, we haven't seen an interest rate cut for the US in all of 2025, so hopes that we will see one next week and that it will be the first for 2025 in the US is really helping the US stock market. We've seen the US stock market reaching a record high, the Japanese market reaching a record high, and the Aussie share market also only 2% away from an all-time record high. So markets are rallying. We have a look at the Aussie share market this week, though. It is the second consecutive week of losses, even though it was a small one. And what we are seeing the financials having done well this week, but offsetting that, we're seeing weakness in terms of the miners. I have to say, though, the star area has been the tech stocks. We've seen Oracle in the US up a huge 30% this week, and that's really helped sentiment in the tech sector. So the tech sector is the best performing of the week.
And on our market, Julia, gold stocks, the gold sector, in fact, is up 72% this year so far.
Gold continues to sparkle. And look, gold has a very strong relationship with the US dollar. As the US dollar weakens off, usually we see gold prices rise. And that's a relationship that we've seen for all of 2025. There's a number of reasons behind that, and if we have a look at three of the key reasons, first of all, when the US dollar weakens off, gold looks more attractive to the rest of the world. So foreign investors tend to buy in increasing demand and increasing prices, but also it's seen as a diversifier for a weaker US currency. So we see it as a diversifier for fiat currencies. And then finally, as a safe haven, there are some concerns still around the heavy debt burdens in a lot of the developed world, and some of that is being expressed in terms of gold as well as the ultra long end in terms of bond yields as well. So gold really shining, and gold prices are really doing well. The gold subsector, as you mentioned, up 72% in 2025, up 23% in the past month, and just this week up by a huge 4%.
I mean, there's quite a lot of geopolitical worries in the economy at the moment. Despite that, we're seeing energy prices come down. Why?
When we look at commodities, usually we look at two different sides of a coin. One's the supply side and the other is the demand side. And it really is the supply side of things that's driving prices at the moment. You can think of the supply side as sellers, and in the case of oil, the big oil sellers are OPEC+, and they've been increasing production. And they've been increasing production so quickly that it's offset the increasing demand. So naturally, we've seen oil prices falling. The energy sector has been the worst performing sector this week, and on Friday it was the only sector in the red on the back of those lower prices.
And Julia, the Australian dollar is at a 10-month high against the greenback. What's the impact for investors?
I mean, naturally we think, Aussie dollar's higher, it's good for travellers, but it does have an impact for investors as well. And for Australian investors that are invested globally, when the Aussie dollar rises, unfortunately it means usually the value of their investments globally look less attractive. But the flip side is that for foreign investors that are invested in Australia, they want to see the Australian dollar rising while they're invested here. So if we continue to see the Aussie dollar rise, what we could see is inflows coming through because the Australian dollar is a bit of a tailwind.
Julia Lee, thank you.
Thanks, Alicia.
First, there was K-pop, then K-drama, now K-beauty is the latest craze. Powered by social media influencers, South Korean cosmetic brands are luring young consumers with the promise of so-called glass skin. But behind the glow, there are questions about sustainability. Samuel Yang reports.
First it was K-pop, then K-dramas. Now K-beauty is rising in popularity across Australia. The promise of glowing glass skin. Korean cosmetics and skincare products come with unique appeal at attractive prices.
If we look at a very common product like hyaluronic acid, you will most likely see if it is an Australian-made product, probably something between $80 and $100. For a K-beauty hyaluronic acid 30 ml same product, you can get one for $40 to $50.
Australian entrepreneur Lauren Lee, who's based in Seoul, says wages are lower and South Korea is a manufacturing powerhouse.
We have labs, we have R&D facilities, we have cosmetic chemists, we have all of these things all over the country that you can go to as a company, as a brand, to make your products.
I caught up with Lauren while she was visiting Australia. She now runs her own K-beauty brand after struggling with acne growing up.
There weren't a whole lot of options for people like me. It was pretty clinical, pretty boring, and it wasn't fun or sexy to use skincare.
Australians now have lots of options. Shops selling Korean beauty products are popping up across the country.
By the end of the year, we hope to open 50 stores with the addition of a New Zealand store as well. We're growing at an exponential rate.
Nariko says her customers are primarily Gen Z and younger millennials.
We're seeing that our audience is becoming more and more diverse.
After Koreans, data shows Australian customers spend the most on K-beauty products on a per-person basis, way ahead of Americans. The K-beauty market here is projected to grow from nearly $160 million in 2023 to more than $320 million by 2032.
We really come at it more from a preventative perspective rather than everything's gone wrong and how are we going to fix this.
What they celebrate is this idea of like flawless, poreless skin, glass skin, if you will, and that's not achievable for everyone.
Mainstream retailers like Sephora and Adore Beauty are also expanding their K-beauty ranges, which could put downward pressure on prices as brands compete for customers. The popularity of K-beauty has been supercharged by social media. These influencers behind me are making videos about the products and using them in their beauty routines. This kind of content often goes viral on TikTok thanks to its unique algorithm.
Oh my god. This doesn't even look real. This is the Medicube Collagen Night Wrapping Mask and it went viral because it's...
TikTok has a content-based algorithm, so it doesn't matter how many followers you have, like on Instagram. Because Korean skincare is so aesthetic and it's so visually appealing, it makes for a really interesting video, and you see these creators putting on these masks or this like snail mucin, and then there's an immediate effect to the consumer. This is like a routine on how to achieve glass skin. So she's...
Digital content creation lecturer Brittany Ferdinand says these products raise environmental concerns.
We are seeing a really high product turnover, particularly because it is at that accessible, affordable price point. So it's kind of reminiscent of fast fashion if you think about it, because particularly online, a lot of content creators are doing these huge K-beauty skincare hauls, and there's a lot of plastic involved in that.
Some homegrown beauty brands have incorporated K-beauty formulas into their range.
I've chosen them from 1, their actives, 2, their technologies in creating those formulas, 3, in the way that they deliver. They are very quick to market.
But the Australian brand founder doesn't hold universal praise for Korean formulations.
Whilst amazing at a lot of things, they're not very good with pigment. They're getting better at it, but there's a lot of things like colour cosmetics. It's not their forte.
For now though, Australia's love affair with K-beauty shows no sign of slowing down.
And that's all from Close of Business. I'm Alicia Barry. Thanks for watching.